one thing for sure is that I don't think that assets have been properly marked yet. You know, what's really happened is you have a gap between the buyer and the seller, and it's a substantial gap. There are always opportunities, but I would tell you that right now, and this is coming from a lifelong real estate investor, that I don't see the pricing adjusted yet on the equity side to own long-term equity in the real estate side of it as really attractive. And so what you're seeing really now is slow drips of deals dropping that are situational. And they're situational because typically it has something to do with either the particular property or the owner, the sponsor, whoever it might be, the borrower, that has to resize because when they're refinancing, their loan is up. The rates are entirely different, chewing up entirely different amounts of cash flow. And so even someone strong like us or other stronger players that have deep debt relationships, it's just a pricing function. The prices haven't reset in my mind. And so, you know, transaction volume is down 50 to 80%. And so I think in the meantime, the opportunities are probably like in short-term debt or mid-range debt, where, you know, you're seeing nice yields, and more importantly, you have sort of like the optionality to stay short-term and wait for the repricing to occur. So if I go through the different asset classes in terms of where the opportunities are, they just haven't really repriced yet. Everyone thinks of multifamily as the ultra safe asset. And of course, from a rental demand point of view, that's likely true always, or in many cases, in many parts of the country. But it's a question of where is it priced? And because it was priced very, very competitively in the early years, let's say going back 3, 4, 5 years ago, when that stuff rolls, the question is, you know, price and where can you enter it and buy it? And so that's a big dynamic. You know, Bill touched on office. I mean, remote office function, combination of interest rates and when a asset class goes out of favor, not a good combo. So the office building market is challenged, and I'm not sure that the lenders have really dealt with that pain yet. And so you're seeing it come up when people actually need to deal with it. But I think a lot of those loans will have to be resized, and that'll mean to the developer that they'll have to add more capital or increase guarantees and other things that they weren't expecting. Industrial seems to be holding across the country. You know, I guess the question of industrial, so much of it was developed in the last few years. So I guess it's a sort of forward-looking demand issue. But I would say that safe student housing, the run-up of just the cost of school, of actually sending your kid to school, is become prohibitive for many. And so that, in theory, would affect student housing. And the same sort of issue relates to the debt rolls. And then retail, there's something other going on, which is obviously a number of years ago with the obviously the e-commerce effect. Now you have the crime effect. So you have a number of retailers actually that are rethinking certain stores. And so you put all these things together, and I think that there will be a market reset. And I think that's healthy for the real estate business to clear and reset, but we're not seeing it yet. So I think in the meantime, it's make sure you have powder and wait for it. Now, inflation historically is like not a terrible thing for the real estate business in the sense that rents typically grow faster than expenses. In this instance, though, it's a little bit different because think about your biggest expense is mortgage expense or your interest expense. So that has had a huge run up. And you have on the expense side, the general inflation that's occurred on the cost of operating properties, whether it's labor and other sort of operating like expenses. And then you have insurance. And in certain parts of the country, the insurance business right now is going through a major, major problem. And it creates a situation where not only has it gone up in terms of the premiums and the cost, but whether you can get it and whether you can meet the insurance criteria the requirements at the bank is basically telling you need to buy a property. If you had a, $80 million industrial facility in Florida in a certain sort of, let's say, sensitively coastal area, a bank to finance that may put full replacement value on that, meaning go out and get the replacement value, whereas you can't actually get it from the insurance company. And so that creates huge gaps in what deductibles might be, whether you can get the insurance, then get the lender. So you have sort of different things happening. So I think it's not only cost, it's availability. And I think the market is sort of, that's another thing that's happening. It's particularly happening in very sensitive areas, obviously California, coastal places in Florida, the Carolinas, other places. But I think it's just floating its way through the market. And it's another shoe to drop that's, hasn't been fully baked into the underwriting yet, in my opinion. I think the opportunity in the next year or two, because of sort of the way the debt is coming out to us, is going to be structured around the debt, meaning debt discounts, buying debt back cheaply. Sadly, I think a number of the banks are going to take large loan hits. I think sponsors and developers who overpaid for properties or for whatever reason couldn't get the property where it needed to be in a stabilized way are going to take hits. And I think a new buyer can come in and maybe use, the participating debt feature. I mean, we are traditionally long-term equity players. We buy properties and hold them really for long, extended periods of time for cash flow and upside. But I think there might be a way to use capital in a way where you can come in a first position or even a second position if the numbers are right, and then have some participation in the equity. And that might be a way to sort of enter the game with some downside protection, but with some upside potential on sort of a resetting of the value. So that's what I would hope will occur, I guess, the way I'm looking at it. And then I would just sort of end with, I sort of feel like a combination of a real estate executive, a therapist, and a financial advisor in a lot of ways. Meaning, I basically feel that it's my job to go out and to just be available to people and communicate and be a liaison and sort of. So I try and think about people a little bit more wholesomely in terms of where the best circumstance is for them. And I find myself asking more questions about what their objectives are and what their concerns are, and trying to use that in a way to sort of help advise, sort of like in a real estate point of view in terms of what we do, where things that they might consider. And so, I view that it's something that I personally enjoy, but I think that's the positive that will come out of the industry here, is that I think there's more and more people doing that, looking at people wholesomely and not just about a particular product, but more about what the objective is for, a particular client or investor or whatnot.